So let's talk about first security mortgage. We'll talk about first security mortgage today. What is it? What do you guys do? And what's your process?
So First Security Mortgage, we are a hard money lender. And a hard money lender is a lender that does loans just like a regular A-paper lender would do, Bank of America or Chase. The only difference is our rates are higher, our terms are shorter, and our interest rate's higher. And typically people that come to a hard money broker is someone who doesn't want to, one, doesn't have the time to qualify to go through Bank of America, Chase, Wells Fargo. Number two, doesn't qualify. They may be self-employed. They may own their own business and write everything off, so their tax return income doesn't really indicate what their truthful monthly income is, and so they're unable to qualify. And the third reason is timing. A lot of times if you buy a home and you're going to Bank of America, it could take 45 days for the loan to close. Many times when you're making a purchase in today's competitive market, you don't have 45 days. So there's an advantage to be able to close in 10 days or less. You're gonna be more competitive with an all cash offer. So basically, First Security Mortgage is a hard money broker that originates loans in California only, and we service the loans that we originate. And that is the basic difference between us and a traditional lender. And our loans are never sold. So once we close a loan, unlike a traditional lender like Bank of America that may sell off the loan many times, with us, it always remains with us.
Okay, sweet. So how long has First Security Mortgage been around, and how did it get started?
So First Security Mortgage has been in San Diego since 1972. We haven't changed our name or our phone number since 1972. And a lot of players have come into our business, the hard money brokering, and they last 5 years or less. They get in trouble, they close their doors, they mismanage, whatever it may be. So we've been in business for since 1972, for 52 years now. And I have been with First Security Mortgage for about 35 years. This was a family business. My mother actually became the owner of First Security Mortgage, part owner in 1978. She became the full owner in 1980. I didn't graduate high school until 82, and in 1983 I got my real estate license. Back in the 80s we had about 25 employees, and my mother and father both worked in the business. I've had brothers and sisters that work in the business, and as of about 10 years ago, my mother and father have fully retired, and now my brother and myself run the company. And really we're just a 5-man shop. There's 5 of us here in the office, and then we have various people that are field reps out in the field that are going and soliciting loans from other realtors, other mortgage loan originators, and from whatever sources they can get the loans from.
Okay. So break down hard money loans, what they are to me. Break it down to somebody that's never heard of hard money loans before. This is a brand new term. What is a hard money loan?
So a hard money loan, really, back in the day, soft money and hard money were the two terms. Soft money meant that you borrowed from a bank, you owed an existing loan of $200, you went and you borrowed a new $200 at a lower rate. It was a soft money refinance. Hard money typically meant that you pulled cash out. You owed $200, but you pulled out a loan for $300, so you got an additional $100,000 out. That was hard money. But now, that's 30, 40 years ago, now hard money means higher interest rates, higher points, shorter term, but there's an ease in getting the loan. You can get the loan quickly. Many people think that hard money is risky, and it's just the opposite. We don't take any risk. We're risk adverse. In fact, our guideline, our business model is on a purchase, you've got to put 30% down. You can go to bank and put nothing down. You can put 5% down for a first-time home buyer. You can put 10 or 20% down. Back in the day, 20% was the customary amount to put down. But as property values increased so much, lenders came up with alternative ways of getting people into a home. We still require a minimum of 30% down. So what is hard money? Higher interest rate, higher fees, shorter term, but accessibility if you as the buyer have skin in the game. You can have perfect credit and you only have 10% or 20% to put down, I can't help you. But if you have 30% down or more that you have saved up, that's your skin in the game, then we can help you, and we don't care what your credit score is. And unlike a traditional A-paper lender, when someone goes to an A-paper lender, they've got to fill out a loan application, they've got to have their credit score ran, they've got to provide bank statements, they've got to provide tax returns. The lender then, the broker, the loan officer then packages that up, submits it to an investor, an underwriter, and ultimately an investor. They say what the interest rate's gonna be, and it's a back and forth. It's in flux what you're gonna be charged, and it can take 45 days to close. With us, hard money, it's all predicated on equity. So a borrower calls me up, a buyer or a borrower calls me up and says, I'm buying this home in La Mesa for $1.2 million. I'm putting down $400,000. Here's the address. I'm gonna live in it as my owner-occupied property. Now, First Security Mortgage, just based on that information alone, give me a detailed loan proposal. Hard money will give you a detailed loan proposal based on that information because it is basically skin in the game. Once they agree, then we'll get their loan application, then we'll run their credit, then we'll ask for proof of funds to close, then we'll get all their personal information. Our way of doing business is we don't want your personal information, nor do you want to give us your personal information if you don't agree with the terms that we're offering you. If I offer you these terms based on what you told me, La Mesa, 1.2 million, you're putting $400,000 down, and I say, here's your proposal, and you look at it, you go, forget it, it's way too expensive. I have never been provided any of your financials. But if you look at it and you say, yeah, you know what, I understand, it's great that Bank of America is gonna give me 7% and 1 point or no points. That's great. And First Security Mortgage, you're gonna give me 10.5 at 2.5 points or 3 points. It doesn't do me any good, Bank of America's loan, because I can't get it. My tax returns don't support my truthful monthly income, or I'm in competition with an all-cash buyer, and once I tell them that I'm having to go through Bank of America, they're gonna go with the all-cash buyer. Okay. So they can come to us and they can say, yeah, it's costing me more. It's costing me 15 grand more. But isn't that a small price to pay when you can compete with an all-cash offer and we can close in 10 days and we can remove loan and appraisal contingencies within 3 days of the accepted offer? Now we're competitive with somebody who's doing all cash. So what's hard money, to summarize? Hard money is not risky. You as the buyer or the existing homeowner have to have a lot of skin in the game, but there's a reason why you don't want to go to a bank and you're willing to pay a higher rate and higher fees to get the money quickly. And with our loans, there's no prepayment penalties, so they can pay us off at any time. And our terms are much longer than all of my competitors that offer 1 year. You may think 1 year is a long time, but we offer, in most cases, 7 years with no prepayment penalty. That gives you all the time in the world to get into the home. Now you own it, you've closed escrow, now you can go to Bank of America, and if it takes 6 months to get refinanced, you don't care. Your family's already in the home. You take the time, you put 30% down, so obviously you can afford the higher rate temporarily. That's basically what hard money is.
Okay, so yeah, you probably have a lot of clients or borrowers that are taking your money because they need it fast, they need it quick. They get in the home and then they're refinancing a year or two later at better rates with cheaper money, right?
Yeah, and typically it's about a year.
About a year. Okay. What does your typical borrower look like? What's their occupation? What kind of?
So, there's a misconception that the hard money borrower is someone who is being taken advantage of, someone who's less sophisticated, when it's just the opposite. Our average hard money buyer or borrower typically, and especially on the buying side, typically is well-to-do. They have a huge down payment. They've got that huge down payment because they own businesses or they have an employment that provides them excellent monthly pay. They make a good amount of money. They're usually sophisticated, and many times they're business owners, and they have excellent credit. That's our typical buyer when it comes to hard money. Now, when it comes
with
to
excellent credit, I would have thought
right.
It's people with knowing or no credit, low credit, whatever.
That's right. You would think in the 500s and 600s. No, we get people in the high 700s and 800s with credit scores.
Wow.
But if they own their own business or if they own multiple properties, it is a nightmare still to go to one of the big lenders and say, I want to buy a home, and what's your source of income? Well, I own liquor stores, as many of the Chaldeans here in San Diego do. I own liquor stores, multiple liquor stores, and by the way, I own 5 other homes.
Wow.
You would think that such a solid buyer would actually be easy for Bank of America, Chase, and Wells Fargo to finance. It's just the opposite. It's very difficult. They prefer someone who's W-2'd, works at Qualcomm, doesn't own any other properties, has one auto payment. They like just the cookie cutter stuff. So our buyer typically is more sophisticated. And they understand, yes, it's costing me money, but I've got to get this property. And it's going to cost me a lot more money if I try to go A paper and then I lose the deal. On the non-buying side, now we have a variety of borrowers. We have people that already own a home anywhere in California. And what are some of the reasons? Well, you may have someone that recently both parents passed away. There is a reverse mortgage on the home that's now all due and payable. They have inherited the property, but it's in probate. So they technically don't own it. And they have a loan, a reverse mortgage, that's been called all due and payable and may be in foreclosure. And there's a very small amount owing. The home could be worth $1 million and they owe $150 on this reverse mortgage that has them in foreclosure and is going to eventually schedule a sale. They are in probate. No A paper, when I say A paper, Bank of America, Chase, Wells Fargo will not do a loan to somebody that owns a property that's in probate. They're called the executor of the estate. They won't do it. We will. As long as they have letters of testamentary and they have the full authority granted by the courts, which they almost always do, to encumber the property, we can do a temporary loan to pay off that reverse mortgage. And then, once probate closes and they've paid on our loan for 6 months, then they can go out and get a traditional loan. We have other people that own their home free and clear, and they want to pull cash out because they have kids or grandkids that are getting married. They may have decided, you know what, we owe very little on our home, and we now want to build an ADU. Okay, well, you want to build an ADU, and you go to Bank of America wants to know what contractor you're using. They want to see all the plans. They want a fund control. That means they're controlling the funds. You as the homeowner, who you have all this equity in your home, you have very little control. With us, they come to us and, okay, your home's worth $1 million. It's over in La Mesa. It's over in El Cajon. It's over near Mesa. Wherever it's located, it's worth $1 million. You owe very little to nothing on it. And you want to pull out $300,000, so less than 50% of the property value, to build some ADUs. And you're already working with the contractor, but you want us to loan you the money, and then you do what you wanna do. Whether you build the ADU or whether you go to Las Vegas, we don't care. Why? Because we are loaning you the money based on what is the property worth now, and is our investment secure? So we give them the whole $300,000, and we mind our own business. Now they go and build that ADU. Once it's complete, they've had no involvement from us. Once it's complete, now they can go out to Bank of America and refinance, and they don't have to jump through all the hoops that would have been necessary if they're doing the building process. And so basically the homeowners that, if they're not a buyer, the homeowners that are traditionally coming to a hard money lender typically do so for the same reason that a buyer does. They want the simplicity, they want the speed, and they don't qualify for some reasons. It may be that they have poor credit, but in many times it's poor credit and they're self-employed. But they all have one thing in common when they come to hard money. You have to have, if you own the home, you've got to have substantial equity. And if you're buying a home, you've got to have a significant down payment.
Okay. So what, there's a lot of hard money lenders, of course. You guys service here in California. What makes First Security Mortgage different? What stands apart from other hard money lenders?
Number one, our longevity. So I don't know of any other hard money lender that has been in business for 52 years without changing their name or phone number.
Oh, why are they changing their name or phone number?
They typically get in trouble,
Oh, really?
Whether it's bad investments, whether it's a Ponzi scheme. There's been continuously, it surprises me how there are stories of mortgage brokers that run Ponzi schemes. You thought that it only happened back in the 70s and 80s, and then, the Bernie Madoffs seem to never go away.
Wow, jeez.
And so what makes, the question again is what makes us different from the other hard money lenders? When I say most hard money lenders, 90% only originate loans. They will not service the loan, and should a default become necessary, they certainly don't conduct the foreclosure. We originate the loan, we service the loan, and should the borrower not pay, which is a rare exception because again, they have so much equity or they have so much skin in the game on a purchase, if they, for whatever reason, don't pay, the foreclosure is done in-house as well. That is a benefit to both our investor and our borrower. When I arrange a loan, when First Security Mortgage arranges a loan for a borrower, we have interactions and I'm telling them these are what the terms are and everything else. When the loan closes, First Security Mortgage is closing that loan, unless it's a purchase transaction and then there's an outside escrow, but we're still working hand in hand with them. When loan closes, it better be identical to what we told them from the very start. We never switch and bait. When we give them a quote, it never changes. Unlike other traditional A-paper lenders or even other hard money brokers, they're not in control of what the rate is. Most hard money brokers get a borrower that wants to borrow money, then they go contact an investor. They find out what the investor's terms are. The private investor, a wealthy person, finds out what the terms are. They go back to the borrower. There's a back and forth until everyone agrees, and then loan documents are prepared, usually by an outside escrow company. And then once the loan closes, it's serviced by another company, not the broker who originated it. My investor doesn't get involved. I make all the decisions. You and I, as the borrower, we agree upon the loan terms. We process the loan. My investor just says yes or no. Once we close the loan, payments are made to my office, and God forbid anything happen to you. Things happen, you lose your job, you become ill, you get more than 6 months delinquent, we're going to have to put you into foreclosure. Okay, but the purpose of a foreclosure is not to take away your home, it's to force you to bring the account current or pay us off. I'm conducting the foreclosure, the person that originated your loan, and we treat the borrower the same way when they're behind in their payments, or God forbid on the rare occasion a notice of default, putting them into foreclosure becomes necessary, I and my office treats them with the same respect that we treated them when we were trying to get them to originate the loan. Business is business. Whereas with other hard money brokers, they originate the loan, they have very little control over it. Once it closes, you, as an individual, as the borrower, are making payments either to a private investor directly or to a servicing company that has no idea who you are, and the term is for 1 year. When I do a loan, when First Security Mortgage does a loan, we do the whole thing. You make payments to our office, and there's no 1 year terms. You get the loan for a minimum, at least 7 years, which is important.
So I've heard there's other mortgage brokers that will do investment pools. Do you guys do investment pools?
So that's a great question, and the answer is no. The reason we do not do investment pools, an investment pool is when it makes it very easy for the broker, much easier than the way I do business. Basically, a broker has access to funds, as do we. We'll have a credit line that we have access to 5 million, whatever the dollar amount is, and as a borrower comes in, we fund the loan. As another borrower comes in, we fund that loan. Then we get $10 million of funded loans, and then we sell a certificate of ownership to individual investors. So an investor calls me up, we're interested in making 10% on our money. What do you have? I have an investment pool. I have $10 million in loans, and you can buy a percentage of it. The advantage is if you have 20 loans in there and 2 of them aren't paying, but the other 18 are, the investors are gonna get consistent payments every month because they don't own the 10 million, they own 500,000 or 700,000 or $1 million of the 10 million pool. And the pool could be much larger, I'm using 10 million as an example. It makes it very easy on the broker because I have my own wire, my own funds available via the word I'm thinking of is credit line. So we have our own credit line, and we don't need to get a borrower in, get his package, and then call an investor and say, do you want to purchase this trust deed, this mortgage? Put the paperwork together because this investor will be named on the deed of trust. He'll be named solely on the note. He will be the sole insured on the title policy, and that's critical that you're the holder of this. An investor wants to make sure that when he loans $700,000, it's against a property that's worth $1.5 million. That he's the first mortgage, he is the insured, the title company's insured him. If anyone checks the recording, he owns it. If First Security Mortgage was to close their doors, he owns the note, the mortgage on that individual property. When you do an investment pool, the pool is only as good as the broker who's managing it. And sometimes the broker, many times the brokers mismanage it. And people, as in Bernie Madoff and other people, don't manage these investment pools, and investors lose. Why? Because when it's musical chairs, when the music stops, there's not enough seats, and you don't own anything as an investor but a part of this mortgage pool that was developed, that was put together by this mortgage broker. So I always say, no, it's a little bit harder when I have somebody coming in as a buyer, and once I have to package their deal and I have to find one investor for this $750,000, and I put them together, and when the loan closes, First Security Mortgage is not listed anywhere. It is the investor that's listed on the mortgage that records with the county. It's the investor's name that's listed on the note. And when a title company issues title insurance, First Security Mortgage is not listed as the insured. It is the private investor. First Security Mortgage originated the loan. We will be the servicer of the loan. But if that investor gets upset with us for any reason, he can pull the trigger notify the homeowner to make payments directly to him or to any other company he decides to have service for him. We put the power with the investor. An investment pool, it's fantastic, it's easy on the broker, and the theory is you've got 20 trustees in there and they're each paying 12%, but you promise the investor 10% or 9.5%. And some of them don't pay each month, but since you've got 20 in there, the investors can always be paid. They never miss a payment. But it's only as strong as the broker. The way I originate loans and the proper way to do it, if I get $750 from my investor and I place it on this one property in La Mesa, and 10 months later that guy misses a payment, that investor doesn't get a payment. So he's gonna be immediately aware, and there's nothing wrong with somebody missing a payment. People, that's why they're coming hard money too. They can miss a payment. We have a 10% late charge. We're not gonna go after the borrower because they miss a payment. They miss a payment sometimes. Something comes up, they need to spend money somewhere else, they catch back up. But the investor, I have investors, I'm servicing loans right now where the investor is 3 months delinquent. It's a rarity, but there's a few of them that, the investor knows. And it's all in his name. So that's why there's been recent companies, I think it's AB Capital, just was closed down and is being sued because they absconded something like 40 million. It's just gone. So that's the difference between, a real estate investment trust or pooling money together and you sell individual shares. We don't do that. You've got somebody who has 750, I'm telling them, hey, I've got a property worth 1.5 million or 1.2 million. We only go up to 65% of the property value on a non-purchase. And they go look at it, and they go, yeah, Paul, I've driven by that property, or I Googled the property, and yeah, so I'm gonna have the first lien, just like Bank of America would, I'm gonna have the first lien or the first mortgage on that property, and if they don't pay, ultimately I could enforce payment by conducting a foreclosure, and worst case scenario, I would own that property for my initial investment, even though it's worth clearly more. Yes, Paul, I'll do that deal. I feel very secure. So I always try to, First Security Mortgage is a fantastic company. We are the most reputable and trustworthy company. But I don't need an investor to trust me. I need them to understand what I'm saying and understand what they're purchasing as far as an investment, because 2 + 2 always equals 4. I don't push the strength of First Security Mortgage. I push the strength of the documents, a deed of trust secured by a note, the note secured by a deed of trust against a property, and ultimately if that borrower does not pay, that homeowner doesn't pay, which is a rarity, then they can take back that property as collateral. I do not tout the strength of the borrower. I don't care if a borrower has a 750 or 800 or 850 FICO. I care how much skin do they have in the game. Am I gonna loan to someone that's got a perfect credit score in La Jolla and their home's worth 3 million and they wanna borrow 2.5 million, I'm not doing the loan. 2.5 million versus a 3 million value, the percentage is too high. I would rather loan over in Lakeside where it's worth 500 and we're only loaning 200,000 and his credit score is 550.
Okay, so we have not received the March payment.
People with great credit scores can get hit by a bus, they can lose their job, they can get divorced. But equity,
so the last payment
for the most part, is always there.
Was for the
So is it always 1-to-1, like one investor to one house, or do you ever have, they're not able to get all of it, so 2,
with
3?
us, it's usually about 9 out of 10 is just one investor.
Okay.
I sometimes will get a loan that is for 1.5 million, and I'll put 3 investors of 500. And many times when I'm doing the 3 investors, they all know each other. So I'll call one investor and he'll go, oh, 1.5, oh, I love it.
let's
all
just
I've
wait.
got's
It's still,
500, can you give me
several
a couple of
days,
hours to let, cause I'm
so
gonna
that, you know,
check
it's
with
not- technically
a
we
couple
don't
of buddies of mine, or I'm gonna check
charge late
with
charge until the
my
12th.
parents, I'm gonna check
So,
with my
we
brother,
still have
whomever may be.
several
I have a
days, and,
friend,
you know, you
and I
haven't
want
been
all
late
three of us
before, this is like the
to
first
purchase
time,
that trustee.
and I
So
can't
in
believe
many
that you
cases,
sent
when
it
it's a
out. So let's just wait a
participation,
few days,
and by law,
if it
we're
doesn't
allowed to
come
put
in
up
on
to
the
10
11th,
investors
which is next
into one
Monday,
deal.
Do they
so,
all go
give
on
us
the
a call
deed?
back.
Who
If
goes
it
on
They
the
doesn't
deed?
all
come
go
in
on the
by
deed.
11th,
Wow.
All of them. So if you have,
then
so
we'll
I
just
rarely,
say,
I don't
send
do
us
10. I think
another
the
one,
most
and
I've
we
ever
will
done is
not
like
charge
5.
you a late charge.
Most of my competitors, they'll do a little $400,000 loan and they'll put 10 investors on there.
Jeez.
Well, you know, you're not dealing with
No,
qualified
no, because
investors,
you
and we
know
can get into
what,
what a
that's-
qualified
no, because
investor is
that
later.
gets to
But
be
they're
a
dealing with
hassle to
smaller
get on
investors
to
that just
have
have 50,000,
You know,
this one
so
has
no,
100,000.
So yeah, don't even worry
No,
about
you-
it, just give us a
You
call
don't
back
really
on
want, on
Monday.
a small
If you feel
deal
better
like
about calling us
1.5 million, you know,
tomorrow,
3
just
investors is
checking in.
good.
We don't get
500,
our mail
500,
until about
500.
12:30
If you have one that puts a
anyway.
little bit more, then he's the
So
majority owner,
if you wanna call
and then
back
he
around
gets to
1
hold the
o'clock
original
or
note
so,
and deed of trust.
1:30,
But when I
just
do a
to check to see if it
participation,
came in, then
my
we can let you know at
participating
that time.
investors
And if not,
typically
don't worry about
know
it
each
over
other.
the weekend, we do get mail
Okay.
on Saturday.
I'm curious,
but we don't
what
know
are
about
what are
it
some of your
until Monday.
longest standing
So just
investors?
give us
Do
a
you
call
have
back
high
on
investor
Monday, and if
turnover,
it's not
or are you
here on
typically dealing with a
Monday,
lot of the same
we'll
people?
So, you know,
then at that point, we'll
again,
call to
because
say,
this is a
"Listen,
family
we're gonna
business,
check
I got
it
my
out, and
license
we
in
will not charge you a late fee."
1983. I got my broker's license in 1990. We
That's fine, that's
give
great.
investors a
That's great.
4-digit
And I'm
number.
gonna put a note in your system.
We
in the
give
system
our
that I will
borrowers a
use.
6-digit
Call back
number.
on Monday
So when I'm
if it's not
originating
here,
loans
just send us
today,
another check, and then
we
will not
are
charge you a
at
late fee.
24,
Yeah,
and
yeah,
I
you're
think from
welcome.
memory,
Absolutely.
24
Oh, absolutely.
for the year.
You're very
that
welcome.
it
Have a good
originated.
night.
So the year 2024, we go
Thank you.
24 dash, and we're at
Right.
9608. So we've arranged, you know, coming up on 10,000 loans since the life of First
Total
Security
total
Mortgage.
loans that you've
So
originated.
getting to your investor, the borrower is 24 dash, a 4-digit number that just keeps building in sequential. The investor is a 4-digit number. So if I get a new investor today, he's gonna be 24 for the year 2024, and he's gonna have a 2-digit number. So if he's 2410, he's the 10th new investor
in this
in the
year.
year 2024.
Okay.
So to answer your question, the longest investor that I have right now, he's 7708. So he has been investing with us since 1977, and he was the 8th investor in 1977.
Wow.
He is still old school, and of course now he's older, and he has known me since I was 15 years old. I'm now 60. I am funding loans with investors that are in their 80s. However, I was funding loans with their parents.
With people that are in their 80s, you're
People that
with
are in their 80s, people that are now deceased, that were in their 80s and deceased, I was doing loans for their parents.
Wow.
So once a family, you know, starts, and usually they're well-to-do, once they start funding loans in the 70s, you know, then as they get older, their kids start funding loans, and then as they get older, then we really haven't had too many third generations. So, you know, I think times have changed a little bit, but you know, I don't have any, but I have a lot of two generation investors. It's interesting to note that in 2007, we had 30 employees. And in 2007, when we had our correction, to put it lightly, in the mortgage market and the world economy as a whole, we went from 30 employees, in 4 years later, we were down to 3.
Jeez.
Because it was a matter of survival. We didn't lose one investor. Not
Wow.
one investor stopped investing with us, not one investor lost any money. Not one investor filed a complaint. I had to make, and First Security Mortgage had to make a decision back in 2007 and 2008 when we saw the writing on the wall. Do we close up shop and open up again with another company? Because if not, 90% of my day was taking care of problems, making sure my investors didn't lose money. 10% of my day went towards origination.
Jeez.
So I had to make a conscious effort, and First Security Mortgage did. We're gonna go ahead and spend 90% of our time making sure our investors' investments end up paying, rather than us and our income as a company and individually went down 82% in 4 years.
Oh my gosh.
Free fall.
Jeez.
But because of that, the investors that we have, they know one thing. And it's very important that we're here. And it's very important to point out, in 2008 through 2012, when we're busting our butts to make sure our investors don't lose money, here's the beauty of it. Do you know how they don't lose money? Quite simply, the borrower doesn't lose their home. If the borrower, especially when property values had dropped significantly, the way to protect my investors was primarily to encourage my borrowers and give my borrowers all the tools and the support they needed to stick by their home and make their payments and not walk away like everyone else did. Because this market will turn around and you'll be glad you did. So what did I do? I told some borrowers, look, that we're thinking about walking, and everyone knows that borrowers walked in 2008.
Oh, yeah.
I told some of my borrowers, yes, we have a second on your home and you have a first. And yes, now property values have dropped to a point where your property's not even worth what's owed on the first, much less our $100,000 second or our $50,000 second. Because back then we were doing a lot of seconds. Now we're predominantly just doing first mortgages, because that whole market changed in 2008. But prior to then, we had a lot of seconds. So what I was doing is telling the borrower's going, look, I'm having a hard time struggling paying Bank of America, and I owe you guys as well. I'm just gonna walk. And I would tell them, no, I'll tell you, how about this? You make your payments on your first. The amount that you're past due with us, you owe us $25,000 in back due payments. You owe us $150,000. You owe us a certain amount every month. We're gonna suspend. There's not gonna be any new interest for the next year. No interest is gonna accrue on your loan. And if you keep your first current, that $25,000 that you owe us, we're gonna waive that too.
Wow.
After a year went by, the market was still bad. They give me their financials, they're keeping up on their first, they did not walk. Because if they would have walked, we would have had to foreclose and protect when we were doing seconds. Now we're just doing first. So we encouraged them to stay in the property, and then a year later, if need be, we gave them another year of no payments. And then once this economy turned around, now instead of having loans that they walked away from and properties they walked away from, now we say, okay, start making payments again to us. The investors were thrilled because yes, they didn't, if you look at the overall, there was a period of time where they were making, 12 and 13%, but because we had to flex and keep borrowers in homes, because ultimately it's best for the borrower and best for us. Yes, there was a period from 2008, I said no investors lost money. They didn't lose any principal, but they didn't get the 12%.
Right.
It dropped down to 8% temporarily for a couple of years. But that's a lot better than the Bernie Madoffs that just took people's money.
Yeah.
So the beauty about trust deeds is we gotta be accountable to both the borrower and the investor. The best way to take care of the investor is to take care of the borrower. Other brokers, it's all about the investor, the borrower doesn't pay, let's foreclose, let's take their home away. No, we don't wanna deal with those type of investors. We will, in a rare occasion, do the foreclosure, but that's not our goal. We want, whatever's best for the borrower is gonna be best for the investor. And I vet each borrower that comes in. So if I have a borrower that I just feel from their track record, I can go on DataQuick and see how many times they've borrowed. We do look at their credit report, not for their credit score, but it tells us a different story. The investor is relying on us to make sure that we're only dealing with good borrowers, and borrowers are relying on First Security Mortgage to make sure that they're not getting a loan from a predatory lender who's at the drop of a dime is gonna try to foreclose on them. We're here to protect both.
That's great. That's awesome. I love that. Sounds like high integrity. Of course, you got a legacy to protect here. Like you said, it's your mother's company that she bought, and so that's really interesting. I love that. If you're a borrower and you want to get started, you need a hard money loan. How do you go about getting started?
So if you're a borrower, you're a borrower or a buyer. So a borrower is somebody that already owns a home. Let's start with them.
Okay.
They better have equity. So if you own a home for 500 and you owe 400, I can't help you. It's all a numbers game. We gotta crunch the numbers. But if you inherited a property, it's worth 600, and you inherited it, and you need to pay off one of your siblings because they don't want to be there, so you gotta pay off one for 200, and you want a $300,000 loan, we can help you. Okay, so you can come to us. If you're gonna purchase again, how can we help you? It's only if you have a significant down payment. That's the only way we can help borrowers. We can only help borrowers that own a home if they have lots of equity. And we can only help borrowers that want quick financing because they gotta find a home and they want to compete with an all cash offer. They gotta have significant cash in hand.
Okay.
And again, because hard money is not risky.
Yeah.
We don't wanna do land. We're a little different. We don't wanna do land. We don't wanna do construction. We will do a loan for an ADU, but the value has to be based on the property as is. We're not going to loan to somebody who says, my home's worth 600, I owe 500 on it, but I wanna borrow 200 more. Well, if they owe 5 and they wanna borrow 200 more, that's 700, it's only worth 600. Yeah, but I'm gonna build an ADU and it's gonna be worth 1.2 million. Not interested. We're only gonna loan them money based on, if we give them the money and they run to Vegas, we're happy because we've got all the security in the world because our numbers work.
Awesome. And how do they get in contact with you if they want to get started?
So we're a little bit old school. You can go onto our website, firstsecurity.mortgage.com, and the first is 1ST. You can go on there and you can submit an application, but we like it the old-fashioned way. We have a cell phone number listed on our webpage and an email. Text us your scenario, email us your scenario, and then we'll get back to you normally within the hour. And again, we don't need any of the financials for a prospective client. We just need their scenario. And in most cases, I do want a property address. But if it's a purchase and you don't want to give me your property address, but you're saying, look, I'm purchasing new construction over in San Marcos, or new construction over in Thousand Oaks, or an existing home in Thousand Oaks, and I'm buying it for 1.5 million, I'm putting half down, and I don't want to give you the address. I can give them a proposal based on that. But as the numbers get a little tighter, they're only putting 30% down, not 50% down. I want to see the property. I want to know where it's located. Because it's tougher. Properties out in the rural areas, Campo, anything that is not in a more populated area. The problem we're having now is fire insurance. So fire insurance is becoming increasingly more difficult for a homeowner to get, and especially if it's out in an area that's unincorporated, that's further from your normal tract homes. Even the tract homes, it's tough to get fire insurance. So we do need to know where the property's located, but very little information to get a proposal. Text or email us, call us at the office, and again, we get that proposal out real quick. My job is not to seal the deal. My job is when you call is to give you an option. This is what I can do. And I give it to you usually in a PDF that gives you 3 loan proposals. You're buying a home for 1.2 million and you say you're putting 30% down. I will give you one proposal at 30% down, one at 35% down, and one at 40% down. Why? Because the more money you put down, the lower the rate's gonna be. So then you have options. And once I've given that to you, you're really not gonna hear from us. Now you go shop and compare with other lenders. You may find some that are a little cheaper, but you're not gonna find any that are gonna give you a term of 7 years. All theirs are gonna be 1 year, and that 1 year comes by pretty quick. I get a lot of calls from people saying, I need you to pay off a loan, another hard money lender, because their note's all due. It was just a year ago.
Oh wow, will you do those deals?
We'll do them on a case-by-case basis. It all depends on the numbers. right? But if they put 30% down and they went to one of my competitors and got a 70% loan, and it's a 1-year turnaround, which technically on owner occupied is not allowable, but they skirt the law.
Wow.
Then a year later, no, I'm not gonna come in and take out my competitor and bail him out of a loan he shouldn't have done. Not that there was anything wrong with the loan, but you don't give a homeowner a loan for 1 year.
Yeah.
Comes and goes too quick. 7 years with no penalty.
Okay. And if you're an investor, and you're, looking to get started here with, first security mortgage, what's the best way to
So
go about that?
again, to call me, and we'll have a conversation, we'll qualify them as far as a qualified investor, but part of the
Is it accredited investors only?
Yeah,
or-
so they have to be accredited, which means they have to have a certain net worth. We're not allowed to really just take someone who has 50,000, 100,000, even just 400,000. That's all the money they have. Trust deeds may not be the best investment for them. The DRE says that, they need to have substantially more net worth. But once we qualify them and we talk about trust deeds, what I make very clear to my investors is I don't invest your money. You don't give me 500,000 and I place it. You tell me how much you have. Paul, I've got 10 million. Let's start out with little trust deeds of 700,000. And that's what I'd like. And I'd like an area, I prefer San Diego. I'll go into Los Angeles. I'll go into San Francisco. They tell me what their requirements are. And then as I get a buyer or a borrower in and I process their package, I vet it about a week before I'm gonna close it, then I will call them and I'll say, here is one I have that I think you would like. And they make that. Any trust deed I present to them is a good trust deed. I have vetted the borrower. If the borrower doesn't pass my vetting, if the numbers don't match, it's never gonna be presented to an investor. But ultimately, when I present it to an investor, it is their choice to say, yes, Paul, I like that one, or no, Paul, I'll take a pass. And I tell my investors, I would rather have a quick no than a long drawn out yes. Why? Because once I call an investor, because I have a file that I've been processing, our office has been processing, and we're a week away from closing. When I call an investor and ask him if he's got 750 and does he want to look at this one, I only make one call. I'm not sending it out to 4 investors, because could you imagine all 4 go out and look? They all do the review, they decide to move money from one money market to another to get and then I tell them, oh, I already sold it to another investor.
Yeah.
So I want them to give me a quick yes or no. Yes, Paul, based on that information, I've looked at, the numbers look great, yep, I know that area, I'll take that loan. Then they're given a full package, loan application, credit reports, proof of funds to close, all the appraisal, title policy, all those things are provided. Recorded deed of trust, all those things are provided. But initially, they're giving me a yes or no based on the numbers. So an investor, what I tell an investor is, I've been doing this for a long time. You're never gonna know what I know. But my job, my goal is to make sure you know 90% of what I know in a very short period of time. I'm never gonna say, trust me, I'm gonna say, understand what I'm saying and have it in writing. Because it does me no good to get a loan that is not properly vetted and sell it to an investor and have that loan not pay the way it should be paying. Does no good. I've had people bring me new investors. Oh, I've got a new investor for you. Usually a loan officer. Other loan officers send me their files. Most loan officers don't do hard money. They do traditional loans. So when they come across a loan that they can't do, they thought they could, but they can't. The guy has excellent credit score, but he owns his own business and they can't do the loan, they send it to me. And so I get good loans. Sometimes I get bad loans. And I look at it and I say, no, I'll take a pass. And I've had a loan officer say, oh, I have a family member that'll do it. And I said, look, I've never met your family member, but I've already said I'm not gonna do this loan because it's not a good loan. I wouldn't give you, if I got a new investor that's your family, I'm not gonna give them anything I wouldn't give to my best investor. So any loan I present to an investor is gonna be a great loan. That doesn't mean they're gonna take it, but I do want them to look at it, look at the numbers, and say, yeah, I'll take it, or no, Paul, you know what? Right now we're in Europe, right now, you know, I'm on the golf course, and I know you like a quick answer, so I can't really look at it, I'm gonna take a pass. But call me tomorrow, because tomorrow I won't be playing golf. I want a quick no versus a yes that takes 2 or 3 days. Any investment that you look at, once I've taught the investor, and that's my goal, each time they buy a trust deed, I wanna make sure that they're learning about trust deed investments. They're fantastic.
That's great. Okay, great. Well, I appreciate your time, Paul. It's been a great conversation. And check out First Security Mortgage for real estate loans and trust deed investments.
All
Thanks a
right,
lot.
thank you. Let's do it again.
Yes, sir.
All right.